Hello class, this is Dr. Fenton. In this video, I'd like to show you how to prepare journal entries for estimating bad debts. Now at the end of the accounting year, more than likely a company will have a certain balance in accounts receivable. And as you know, this represents the amounts that customers owe the company. Now, no matter how hard the company tries, some of those customers will not pay their accounts receivable. A company might send them numerous invoices, numerous statements, but then some customers just will not pay. Either they file for bankruptcy or they skip town or whatever. So what we do as accountants, we estimate the bad debts that probably will happen in the year that's coming up. So these will be adjusting entries at the end of the accounting period. So let's get started. And what I have here is some information. I'm going to let me remove this quickly. There we go. Don't need that anymore. I'm going to prepare entries for the bad debts right here. Information that we have is the amount of future bad debts is estimated to be 10% of the ending account receivable balance. So I just made some numbers up here. These X's here represent numerous entries that are made into the account receivable account all during the year. And I just put down here an ending account receivable balance of $16,000. Now, we on our company's estimate, based on our experience, generally 10% of the ending balance of accounts receivable will not be collected. So we can see easily that 10% of $16,000 will be $1,600. Now, the total of $1,600 is the amount we want into the account after the adjusting entry. This new account here, a new account called Allowance for Uncollectible Accounts. We use this as part of the adjusting entry. And so what we'll do is, again, take 10% times the ending accounts receivable balance, and we would like to have $1,600 in here after the adjusting entry. Well, we already have $100 left over from the year's entries in the allowance account, and it's a credit balance. So if we already have a credit balance of $100 in the account, and we'd like to have a total of $1,600 in this account after the entry, we need to put $1,500 in here, because you would add the current $100 balance before the adjusting entry to the adjusting entry we're getting ready to make to end up with $1,600 in the allowance for uncollectible accounts account at the end of the year. So let's take the $1,600, and your adjusting entry will be bad debt expense, $1,500. Oops. That's the debit, and the credit will be to allowance for uncollectible accounts. And that's the adjusting entry. So this is a new account for us in this chapter, as well as this expense account, but that's fairly apparent. So the allowance account is a contra asset account. And in the balance sheet, within current assets, you'll list your accounts receivable balance of $16,000 in this case. Right under it, you'll put less allowance for uncollectible accounts, $1,600. And then the result is the net balance in that you expect to collect on the accounts receivable. That's called the net realizable value. So it'll be the $16,000 less the $1,600 to show in the current liabilities. Now this is one method where you take just 1% given to us times the ending accounts receivable balance. Now there's another method, and let me go back to the original numbers. Take these out, take this out, take that out. The other method is aging of the accounts receivable. And this will be a more accurate depiction of what we think we will not collect in the future. So what we've done, we've split the $16,000 out into how far past due, if they're past due, in these various balances. So we look at all the customers' accounts and invoices we've sent, the date that the invoices were sent and when they were due. Within the $16,000, $10,000 is not yet due. So the customers have not had to pay us yet. And in our experience, 2% of those are usually not collected. We've looked at the accounts, and there are accounts, $4,000 worth of accounts, that are 1 to 60 days past due. And based on our experience, we don't collect 7% of those. And the others, we 61, now went out to 180 days past due. $2,000 are there. And our experience shows that 15% of those are usually not collected. Okay, what we do after we split the accounts into how old they are, and this will always be given to you in any problem, we'll take those amounts times percent to get the total out to the side. So let's say this is equal to this times the percent. So $200. Let's do the same for the other two. And we've just taken 4,000 times 7 to get this, and 2,000 times 15% to get this number. Total of the estimated bad debts, $780. Okay. Now again, once you go through these numbers, the $780 is the amount you would like in the allowance account after the adjusting entry. Let's go back to here. $780 is what we'd like to have in here. We already have 100, so we only need $680 as the adjusting entry. So we go back to adjusting entry. This will be $680 and $680 for the credit. Okay. So those are the entries you make at the end of the year as part of the adjusting entry process to record your bad debt expense by estimating bad debts. This new account, sort of a strange account, a contra asset account, is used now in the future to write bad debts off against. So for an example, let's go with, let's find someone, say John Doe. We tried to collect from him. He owes us $100. And he is, past 6 months due. We always get return letters, so we don't know where he is. We know he just moved away. So we feel like for John Doe's account, we'll never collect it. The entry you make to write off a bad debt then, once you identify a specific customer who's not going to pay, you will debit the allowance account. And I'll abbreviate. Allowance for uncollectible accounts, let's say, just to abbreviate. It's the same count as this one here. I'm just trying to save typing. You'll debit that account, $100. That's the amount John Doe owed us. And the credit will not be to bad debt expense. A lot of people try to use bad debt expense again, but it'll be to accounts receivable. And so I'll just put A/R for accounts receivable for $100. Now, common mistakes is, I mentioned bad debt expense, and sometimes people will try to debit bad debt expense or credit bad debt expense, or maybe try to debit or credit cash, but those accounts are not affected. When you write off a specific customer account, you debit the allowance for uncollectible accounts account for that amount and credit accounts receivable, and that writes the account off. Now, if it so happens that that customer comes back and pays after we've written the account off, yes, we go ahead and take the cash from the customer. And what we do is just reverse this entry we made when we wrote the account off. So debit accounts receivable for the original 100. And then credit that allowance for uncollectible accounts, 100. So what that does, that sets us back up to where we were before we wrote the account off. Okay, so once this is set back up, we can make the entry to record the cash just like we do any other payment any other customer gives us during the year. Record cash, $100, and then credit accounts receivable, $100. So those are the entries we make when we write off bad debts. In through here, the adjusting entry is up here to write off or to estimate the bad debt, and get that recorded as an expense as part of the adjusting entry process at the end of the year. So hopefully this was clear. So good luck with your studies.